Knowing how to calculate your tax liability for the year is very important. In this video, we'll go through ATO tax rates and how to interpret them. The first step in calculating tax is to follow through on what has been shown in the previous topics. You need to total up your gross income for the year. Note that gross income includes PAYG tax payments. This amount will be accounted for later. You then need to subtract deductions which you are claiming. You will now have your taxable income. The next step is to find the right tax rates based on your tax identity and the current financial year. Australian residents, foreign residents, and companies are all taxed at different rates. So let's have a look at the 2016 individual income tax rates for Australian residents as an example. These rates would only apply from the 1st of July 2016 to the 30th of June in 2017. On the left-hand side, you can see various income tax brackets. Whichever bracket your taxable income fits into is the main one you need to refer to. For example, in this particular year, if you earn $18,200 or less, you pay no tax. If we move to the next bracket, we can see that it has the words 19 cents for every $1 over $18,200. This looks a bit confusing, but we'll make it simple. If, for example, your taxable income for the year is $35,000, you take the highest number in the previous tax bracket, which is $18,200, and subtract this figure from $35,000. You then need to apply the tax rate mentioned in the table, which is 19%. The resulting amount would form your tax liability. Let's now move to the third tax bracket. This time we can see slightly different wording, with a specified dollar figure at the beginning. In this case, there's only one extra step. If your taxable income is $50,000, again, you subtract the highest number in the previous tax bracket, which is $37,000. You also apply the 32.5% tax rate mentioned in the table. And then all you do is add this to the $3,572 specified in the table. The resulting amount would form your tax liability. Okay, let's move to the third step in calculating tax. The next thing you have to factor in is that the government may have other additional taxes for the year. An example of this could be the Medicare levy of 2%. With the Medicare levy, this rate is calculated on all of your taxable income. So if your taxable income is $50,000, this means you'd face an additional $1,000 in tax. Step 4 is to take your calculated tax liability up until now and subtract any tax offsets that may be applicable in the current year. The government creates tax offsets to help reduce the tax payable of individuals meeting a certain criteria. An example might be the low-income tax offset for low-income earners, or the beneficiary tax offset if you receive certain government benefits. You must note, however, that if your tax liability is zero for the year, then you can't claim tax offsets to get a refund. Finally, step 5 is to take your remaining tax liability and subtract PAYG tax payments that you've already made. The result is your final tax liability. Now, if the result is a negative number, this means that the ATO may have overtaxed you and you may be able to get a tax refund. And that is, on a very simple level, how to calculate your tax. Remember, if you're ever unsure about any of this, speak to someone from the ATO or consult with a tax agent.